Right guys, welcome back to another video. It has been a little while since we've put a video out, but I'm coming through and straight to the point. We are not messing around today. I've literally put together this PowerPoint for you guys, simplifying ICT, and I literally couldn't simplify it anymore. I've got it down to 3 simple steps that you need in order to be profitable whilst trading ICT concepts. So let's waste no time and let's get straight into it. Showing a little backstory about my journey, it has always been a goal of mine to simplify trading, because throughout my trading career, I've always found everything so overwhelming. There's so much content out there, especially nowadays with ICT. There is new videos getting produced by ICT himself and many other ICT traders, completely overcomplicating ICT concepts in general. And this is why I make these type of videos, very much simplifying it so literally anyone could understand ICT. And trust me, I've been through it all. I've been through all of the systems, strategies, indicators, only to lose money. And at the start of my trading career, I was doing all of the things you guys have probably already tried yourselves already, and only to find yourself unprofitable. And this is where inside this video I'm going to give you a step-by-step guide of what you actually need in order to be profitable trading ICT. There's 3 main problems with many ICT traders. The first problem is that you're constantly bouncing from model to model. Do you find yourself bouncing from model to model? When you find a model that works, or even if you're sat at break even, that's good. Even if you're at break even, do not be harsh on yourself thinking that you need to be pulling these 6-figure payouts that you see on social media, and you see even 5-figure payouts, 4-figure payouts. You see people getting these on a consistent basis. Do not think that you need to get to that level right now. If you're break even trading your strategy and trading your model, stick to one model. Don't bounce from one model to the other constantly. Otherwise, you're always going to find yourself chasing tail and you'll never be profitable and confident in one single model. And this happens to the best of us. Many people, they set goals only to lie to themselves. So you would set a goal saying that by July you want to have this much funding, or you're going to watch the whole of the 2022 mentorship or the Market Maker series. They're the 2 mentorships by ICT himself that I recommend. They're the only 2 ones which I've really thoroughly watched multiple times, and that's what's got me to where I am today, obviously with a lot more other research and practice over the years, which is very much needed. You can't just watch the 2022 mentorship and think you're going to be profitable without actually going into the ring and having a fight. It's very similar to boxing in a way. You can watch many boxing matches. You could watch Mike Tyson fight when he was in his prime hundreds and hundreds of times, but unless you get yourself in the ring, you're not going to be a good boxer. And it's the same with trading. So when you're new to trading ICT, it's important that you backtest every single week. So whether it was a profitable week or a losing week, and especially on a profitable week, because you may think, oh, I did everything right that week. Okay, well, maybe you didn't. Because just because it was a profitable trade does not mean that you actually had the right thought process and took the right position. So it's important to backtest. And I recommend, guys, I'm not affiliated with them at all, but I do recommend you sign up to TradeZeller for backtesting purposes. You're able to backtest, not like TradingView, where you can only backtest maybe a couple weeks on the 1-minute chart. On the 1-minute chart, all the way through all the other time frames, depending on which time frame you actually trade on, you can backtest on TradeZeller literally around 10 or 15 years of data. So there's endless backtesting, and also the week that you've just done yourself. And problem 3 is, which we've already discussed, you're overwhelmed with all of the useless ICT content on social media. That's why you have me, guys. And let's dive into the next slide where I'm going to give you that step-by-step guide. So there's only 3 things that you really have to know, and one other thing that I'll mention later in this video, which we're also going to go over with a full breakdown trade of a very clean setup that we took a few months back as well. So the 3 things that you must know: this is our A+ model right here. A+. You have a unicorn model inside of the macro and a power 3. So pair these 2 together, you have your A+ model. A power 3 is when price accumulates either at the New York Open or prior, or just prior to the macro. Then you have some sort of manipulation below sell side or buy side liquidity, preferably London lows or London highs. You mark these levels out between 2 a.m. and 5 a.m. New York local time, and you're going to mark the highs and the lows of the London session, and these are going to be the major draws on liquidity for the New York session, both the 1st and the 2nd a.m. macro. When you approach the PM session, you want to mark out lunch highs and lunch lows, which rest between 12 p.m. and 1 p.m. That's the lunch session, and you want to mark the highs and lows, similar to marking London highs, London lows. You mark that for the PM session. Not always you're going to have lunch highs, lunch lows. So if you don't, then just mark any other major buy side and sell side liquidity, preferably with imbalances resting above or below. That makes the liquidity level more high probability. We're also going to go into more detail about power of 3, but accumulation, manipulation, and the distribution phase is when you make all of the money, because you identify accumulation, you identify manipulation, and paired with the unicorn model, when it sweeps that short-term low or short-term high, you get that sharp market structure shift in the opposing direction, paired with a breaker block inside that fair value gap which branched away, which caused the displacement. That will be your unicorn model after the power of 3. That's an A+ setup inside the macro, preferably the first macro. The first AM macro at 9:45 AM to 10:15 AM. This is my favorite macro as it tends to be the highest probability with the clean setups, and you guys already know, close to New York Open, price is extremely volatile. Let's dive straight into the next slide. Okay, so understanding points of entry. There's 5 points of entry that you guys need to know, nothing more. Fair value gap, I for value gap, obviously when it gets inverse, order blocks, breaker blocks, and mitigation blocks. Mitigation blocks and breaker is very similar, but for a mitigation, it's when it does not take that short-term high or short-term low, and that will be your mitigation block, considering that it does not sweep the short-term high. And then for a breaker block, you look for a liquidity grab at buy side or sell side liquidity, and then you anticipate a sharp market structure shift after the liquidity sweep. And then it's very simple. You just identify the last opposing candle, which was bullish or bearish, depending whether you're long or short, and that is your breaker block. And then you wait for price to return to this zone for a confirmation or entry. Not always that you're going to enter off the breaker or mitigation block, because you want to enter off the first point of entry. As long as it has a valid stop, then you're going to take the trade based on the first presented fair value gap, order block or breaker block mitigation, considering that the stop placement is valid. So I hope you guys understand what a breaker block and mitigation block is. And also another key question that people ask me all of the time: how do you know which point of entry is valid? It's very simple. Obviously you enter, as we just discussed, off the first entry point that is presented with a valid stop loss, considering that the trade has not been invalidated. So this is one thing that is very important to identify as well. If price has already moved a lot since your first point of entry, so you was looking to enter long off this bullish fair value gap, let's say, so you've identified your A+ model, or you've identified a setup which you like, and you want to engage off this fair value gap, but price continues higher and does not give you an entry, then you have to identify, has price now taken a short-term high? Has price now invalidated this trade? It doesn't matter how clean it is, but if it's already moved around 80 handles since where you was actually looking to enter, you do not want to try chase that trade. And then, as you guys already know, order blocks are a level in price where it is supposed that institutional orders are placed. And guys, if you find these type of videos useful, it helps a lot for the algorithm on YouTube. Smash a like on this video. We're not yet done with this video, by all means, but if you find these videos useful and you enjoy this type of straightforward content where I'm teaching you guys without all of the waffle from other ICT traders, then make sure to drop a like and comment any questions that you guys have as well, and I'll try answer as many in the comment section below. So now we're going to do a full breakdown trade of one of the trades that we have taken inside of the group as well, and it's smash final TP. This was a few months back, but I thought I'd show you guys a very clean setup indeed, and let's get straight into it. It's on TradeZeller. Okay, so getting straight into this breakdown, this is a trade that we took a few months ago back in September. Smash final TP, super clean example, so I thought I'd show you guys on TradeZeller's backtesting tool. We start on the 15-minute time frame, and we're going to mark out the key buy side and sell side liquidity levels for this macro. I'm showing you guys an example inside of the second AM macro here as well. So let's mark out the key liquidity levels on both NQ and ES. Okay, so obviously marking between 2 AM and 5 AM, we can see here that we have a clean set of London lows, which we'll look to get swept prior, and then we can look to target the opposing liquidity if price offers us a clean setup or not. And I'll quickly pop it up on the screen of the proof that we actually took this inside of the group. So I'll pop up a screenshot top right of the screen just now. Okay, so let's quickly drop down to the lower time frame and monitor price as we approach the macro. Okay, so obviously with a major drawn liquidity of London lows for the second day macro, as we approach it, I want to see this short-term low here for NQ get taken out, and also take out London lows at the same time as well. So let's monitor price and see what we get. Okay, perfect. So you can see price has only slightly swept London lows, but we've also taken out that short-term low. It did not take it out on ES, which is not a problem because we did actually sweep another level of sell-side liquidity on ES at the same time here. So this level's been swept. It doesn't have to take it on ES, but it did slightly take it on NQ. It's very important when monitoring NQ that ES is also moving correlated at the same time as well. So you want to monitor both pairs. Obviously, they don't have to move the exact same. You can mark SMA SMTs between the two pairs. So if ES was to not take the low and NQ did, that would be a SMT, a bullish SMT for ES. And if ES took the low and NQ didn't, that would be a bullish SMT for NQ. And in this example, NQ and ES has both taken that short-term low and also swept London lows. And for a displacement in price, we'll look for a displacement above this previous short-term high, or maybe some of you call it a market structure shift. It's all the same thing. Okay, perfect. So now we're inside of the macro and price is cleanly displaced higher on both NQ and ES. So super clean example, London lows swept, clean displacement higher, and we've also got this first presented fair value gap. And I'll delete this off the chart to make it a little bit cleaner. So this is our end of macro. You don't take any trades outside. If the trade does go outside, it's not a problem, but you must be out of the trade by 12 p.m. for the second day of macro. For the first day of macro, you must be out of the trade by 11 a.m. So it shouldn't take longer than an hour, but for your entry window is between 10:45 and 11:15. And for this example, we're going to look to enter long off the first presented fair value gap, not this lower one. We enter off that first point of entry. The stop placement is also valid, so we're going to run a 25 handle stop, which is at 987. In case price wants to draw and tap this lower 1 minute bullish, our stop rests below this lower 1 minute bullish as well. And our first TP is going to be at this short-term high for around 32 handles, and then we're going to run our second TP at the 62% retracement of the move that is just created. The one thing I don't like about TradeZeller is the color of the fib tool. It's moving to LGBTQ and all of that stuff. You know, I don't really like the color of this, but you know, it is what it is. And we're going to run our second TP at the 62% retracement, which will be at this level here, which is at the upper part of this 1 minute bearish gap. And our final TP will be at the opposing liquidity, which we'll run just below. And people may ask me that question, why would you run it just below and not at buy side? In case price, because I have had it a few times, price will come all the way to final TP, and if you ran it at this level, it will create equal highs and it won't fill you. So for the sake of a couple handles, I run my final TP a few handles below at 150.25, and there you have it. Okay, so we've not yet got an entry for price, so let's see within the next 1 minute or so if we manage to catch an entry off this upper 1 minute bullish gap. And for this example, obviously I'm trading with demo funds on TradeZeller backtesting tool, so no way am I telling you guys this is a live example. This is for educational purposes only, and we do trade live every single day, but for this example it's on a TradeZeller backtesting account. So let's see whether we get an entry off this upper 1 minute bullish gap. Okay, perfect. So you would enter long as price has literally just tapped this 1 minute bullish gap. Price has come back in, and you would enter long and run your stop at 25 handles. Sometimes you can run it at 30 handles and possibly minimize your position a little bit less, but for this example you'd run it at 25 handles and enter off the first presented fair value gap. So let's see how this trade plays out. And there you have it. So first TP's been hit, and in this case we're going to move our stops to break even and close 50% of the position. So it's not only risk free, but you've also secured 33 handles so far. Okay, there you have it. Second TP has now been hit. And if you're taking a look at price here, there's only one swing low as we currently stand in order to trail your stops to. So you're not going to trail your stops to anywhere in this area. Leave your stops at break even, and at second TP you close a further 20%. So you'd be around 70% closed out of the position so far, running say one contract to final TP and having your stop at break even. Okay, so as you can see here, price has now created two short-term lows. Therefore, after second TP, you want to trail your stop two short-term lows behind. So 1, 2, and you trail your stop to this level here, which is a valid stop placement, and price should not come back to here. If price wants to take this short-term low where people may over trail their stops too tight, it will take them out and it will get enough liquidity in order to go to final TP. But if price was to come back two short-term lows behind, which is usually extremely rare case, and it means that the trade will most likely be over and it will go all the way back to break even. Okay, so let's see how the rest of this trade plays out. And once again, we've created even more short-term lows. So we're going to trail our stops to this short-term low at 0.92 once again. So securing more profit along the way. And there you have it, extremely algorithmic. This is a very clean unicorn model setup. London low swept, displaced higher. We also have the breaker block inside of the fair value gap. Very clean example indeed. And you would enter off the first presented fair value gap, and see vice versa for ES. We also got the displacement higher on ES, which is great to see. both pairs are correlated, and that would be 138 handles secured. And guys, that is pretty much it for this video. If you have any suggestions for the next video, make sure to drop it in the comments below, and I will take notes and make sure I get that included inside of the next video. Also, hit the likes up on this video. Let's try get 500 to 1,000 likes and push out to new people who would like to see this video as well. And for others that want to see me trade live day in and day out, there is a link in the description if you want to watch me trade live. That is also an option for you as well. I'll see you on the other side. And other than that, guys, have a great rest of your weekend, and I'll speak to you shortly.